That's going to be very negative psychologically for the market. Crypto market, to me, again, looks like it's getting ready for a big sell-off.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
The only problem that he acknowledged with consumer debt, in fact, he said it wasn't even a problem yet, but he said he was watching the consumer debt. This is in response to the question on, people with a lot of credit card debt and how the high interest rates are hurting them. And he said, look, we're monitoring it just to see if there's any stress there, like if there's a problem with repayments, if delinquencies are picking up, but we haven't noticed that yet, so all this debt is okay. But again, he didn't recognize the inconsistency. Why would a strong economy result in consumers taking on so much debt? And it's not just the consumers, it's the government that is taking on massive amounts of debt. We've got record budget deficits. Families are running huge deficits. They're depleting their savings. They're running up their credit card debt. How is this a sign of a strong economy? It's a sign of an extremely weak economy that's being supported by a mountain of debt. The only reason consumers are spending is because they keep borrowing. The only reason the government is spending is because it keeps borrowing. That is a sign of weakness that Powell does not even want to acknowledge. And the other problem, when Powell refused to acknowledge the debt and the consumer spending, right? He keeps talking about consumers are spending and consumer credit. That's part of the inflation problem. The definition of inflation is an expansion of the supply of money and credit. Credit is part of the money supply, is part of the purchasing power. And so if credit keeps expanding, that continues to exert upward pressure on consumer prices. So despite the fact that Powell is talking about this restrictive monetary policy, it's not restrictive. If it was restrictive, debt would be coming down. Governments would be borrowing less. Consumers would be borrowing less. Companies would be borrowing less. You can't talk about how we have tight money, we have restrictive monetary policy, and then acknowledge that everybody is borrowing even more money now than they were before you had this restrictive policy. So monetary policy is still loose. It's not restrictive. Anyway, I want to talk a little bit about the markets. Although before I do, I was watching on CNBC this morning, and they were interviewing this woman who was an asset manager, money manager. And she was very bullish on stocks. Excuse me. Some of that water went down the wrong way. She was very bullish on stocks, which is, why she's on CNBC, because that's, part of the criteria to get on there is you got to be bullish pretty much. But she was basically trying to address the concerns that people had regarding rising interest rates. And she said, look, historically, rising interest rates are not necessarily a problem. And she said, we have positive real interest rates. They're higher than they've been. Now, I still think interest rates are negative because I don't believe the inflation rate, because real interest rates are the nominal yield minus the CPI. Well, right now, the yield on bonds, the short-term treasuries, or the Fed funds rate is 5.25%, and the official inflation rate is like, 3.25%, but they're still projecting it to go down to 2.5%. So she's still talking about, 2.5% real rates, but she acknowledges that that's higher than they have been. It's more than we're accustomed to. I still think they're negative because I think the inflation rate is higher than 5.5%, the actual rate. And so they're still negative, but they're probably not as negative as they were because we have gone up 500 basis points or more than that from zero. But she said that we should look at the 1980s as comparison, that we don't have to worry because things worked out well in the 80s. Because according to this so-called expert who's managing people's money, I'm just glad she's not managing any of mine, but she said that we should look to the 80s as an example of what's going to happen now to the stock market, because she said we had higher real interest rates in the 80s, right? She said they were 3.5%. And so they were higher back then, and the stock market did great in the 80s. And so it could do great now. And I think it was Joe Kernan who was interviewing her, and he's like, oh yeah, that makes sense. So you're saying everything is great and stocks can go up. She talked about this huge rally that the stock market had in the 80s. And so according to her, we could just do the same thing now, which is completely asinine, because what she doesn't recognize is all the other differences between now and the 1980s. First of all, when the decade started, 1980, right, the stock market had been falling since 1966. We were 14 years in to a bear market, and it really didn't turn around until about 1982. It started to go up. But in 1980, the PE on the S&P 500 was under 8. Under 8. Stocks were cheap in 1980. Also, as I already mentioned, the national debt was just $1 trillion. I mean, it seemed big at the time, but obviously compared to today's 33 trillion, it was tiny. But it wasn't just the government that had a lot. I mean, the government that had a lot less debt. Everybody had a lot less debt in 1980 than they do today. And so that meant that higher interest rates were not as big a problem because we weren't burdened by as much debt. We also had a very different economy. We still had at the beginning of 1980 trade surpluses. We were still the world's biggest creditor nation. We weren't a debtor nation. And we had Ronald Reagan president. It was the beginning of 8 years of Reagan. And even though Reagan did some things wrong, he did some things right. I mean, Reagan as president is a lot better than Joe Biden as president. So it was night and day. 80s stock market valuations were super low. And yes, real yields were high, but you know what? They came down for the entire decade. The Fed was cutting rates during a lot of the 80s. Inflation was coming down. The opposite is going to be happening. Now, inflation is going to be going up. And so this is the complete opposite of the 1980s. Yet this money manager is telling people to look at the 1980s for an example of what's likely to happen in this decade, when it's the polar opposite. She's off by a decade, right? She didn't go back far enough. It's not the 1980s. Like I said on my last podcast, it's the 1970s. That's the decade that she should be looking for. That's the decade of high inflation. That's where we are. We're early in the decade of high inflation. 1980s was what we got after a decade of high inflation. But what did it take to get rid of that high inflation? 20% interest rates. The inflation rate peaked out at 13.5, and the Fed got to 20%. Yields on the long-term treasuries were 13, 14%, 15%, something like that. We're a long way from doing what we did in 1980, 1981, 1982 to put a stop to that cycle. We're nowhere near it. And in fact, Paul Volcker, as I mentioned, back in 1980, was telling the U.S. government, cut the deficits, cut government spending, or raise taxes, do something, but you can't keep running these deficits and expect inflation to come down. Well, that's not what Powell is doing. Powell is saying, I don't care about the deficits. I got no comment. We have no input. We don't have any opinion. We're just going to take the deficits as they come, which is a complete cop-out. It's complete BS, because if you're just going to take the deficits as they come, what are you going to do? You're just going to create the inflation, right? You've abdicated your role of inflation fighting, and you've also abdicated your role of being an independent central bank. Independent doesn't mean you withhold criticism. Independent means you offer your criticism. That's the purpose of independence, so you can be critical, so you're not beholden to an administration. It's the job of the Fed to point out to Congress and to the American public what the government is doing wrong. Powell is supposed to say, you idiots, you're complaining about inflation, you're causing it. You're running all these deficits, and I'm monetizing them, because if I didn't, interest rates would skyrocket, we'd have a financial crisis, the banks would fail. Now, of course, what Powell should do is let that happen. See, it takes two to tango. But if Powell wants to avoid that, he could at least say, you know what, you guys have got to cut spending or raise taxes, because if you don't, then I'm going to have to do this. Then I'm going to have to let interest rates rise sharply, and everything is going to crash, and don't come, looking at me to finance your bailouts, because I'm not going to be able to do it. But Powell has no stomach for doing the right thing himself, and he's got no stomach for telling Congress and the president what they have to do. It was just like, he got a question on the strike. And, what did he say? Well, I don't want to take a position on the strike. I don't want to say anything. I don't want to offend the labor unions. I don't want to tell you what I think about this auto worker strike. Obviously, that's a big problem, right? Why he can't say that this is a problem. But again, what he also didn't admit is that the reason these auto workers need more money is because he helped create all this inflation that pushed up their cost of living. This is part of the cycle that the inflation has created. So that's probably why he doesn't want to talk about the strike, because the reason they need to strike is because of inflation. And it's not going to cause inflation, as I said. The higher wages won't cause inflation. The higher wages are the result of the inflation that the Fed caused, that the Biden administration, that Congress caused. And it's not just this administration, it's prior administrations and prior Fed chairs. They've been doing the same thing. We've been creating inflation for more than a decade, 2 decades. How anyone believes that 1 year of rate hikes is going to unravel 2 decades of inflation creating, they just don't understand the point that we're in. Anyway, just getting to the markets did sell off on the close, particularly the NASDAQ. And as I've been saying, that market looks toppy to me. We closed right on the lows of the day. The NASDAQ was down almost 1.5%. We're just breaking below an uptrend. So I think there is a lot of short-term risk in this market. There's a lot of complacency out there. People aren't expecting the market to sell off. It could, there was a lot of hoopla on that ARM Holdings IPO. I mentioned it. It was down again today. It's been down several days in a row. It closed at 52.91. The IPO price was 51, and it spiked up to 69, and it's been downhill ever since. Today's low was 51.25. I think it's going to take out the IPO price of 51, and then it's really going to tank. But if you look at how much the stock has already dropped from its highs, because it went from 69 to 51.5, that is a 25% decline in the last few days. That's already a bear market, right? We've gone from IPO to bear market in less than a week. So that tells you something. But if this thing starts breaking the IPO price so that the people who got lucky and got in at 51, if they're underwater too, that's going to be very negative psychologically for the market. Crypto market, to me, again, looks like it's getting ready for a big sell-off, just like other risk assets, because the Fed has finally stopped hiking rates. Again, it's almost like a buy the rumor, sell the fact. A lot of people thought, oh, when the Fed stops hiking rates, that could be good for stocks, but it actually could be bad. And as the soft landing, fairy tale is exposed, because that's going to undermine the case for earnings. So earnings are going to go down, interest rates are going to stay up. That's bad for stocks, and valuations are already in nosebleed levels. So we have a long way to go down. But again, I think the dollar needs to crack. The dollar was propped up based on all these rate hikes. Well, if the Fed is not going to be hiking anymore, then what's going to be propping up the dollar? Nothing. It's a bottomless pit. There's nothing but air beneath it, and I think it can, fall through that floor. The opposite move, gold's around 1,930. Again, we never really sold off much below 1,900. We got below it a couple of times, but we couldn't stay there. There is some resistance around 2,000, but I think that's paper thin. I think we're going to blow through that. As I mentioned earlier, something could be going on in China, Chinese demand picking up. We could be a day away from any kind of crisis. The debt is exploding. People are starting to wake up. The de-dollarization, the BRIC nations all the stuff that I've been warning about for years on this podcast, and even before I had a podcast, all this stuff is coming to fruition. And you just got to be prepared. You don't want to go to sleep at night without being prepared.